Autoline After Hours is brought to you by Bridgestone Tires, solutions for your journey.
Hey, Gary.
John, good to see you.
Good to see you again after we saw each other in San Diego 2 days ago.
Yes, we did. But we can't talk about it.
Well, we got to let the audience know.
Okay.
You know, we were out driving the Prius Prime. That's the PHEV version of the Prius. And we also drove the Corolla Cross Hybrid. And in about another week or so, next week's show, we could probably talk about these cars.
Mm-hmm.
But they're under embargo right now,
Right.
which the car companies do just to give everybody a fair shot, everybody at the media, because we come in different waves to be able to test drive these things. And
Right.
it wouldn't be fair to let the first wave start spilling their guts about the car before we got a chance to get into it.
Sure. And at this very minute, there are people who are out there driving the car. So,
Right.
fair play to them. But we have lots to talk about.
Yeah. Tell us about it, Gary.
So this is, I would say this is a somewhat special show. We've got Kristin Dziczek, who is the automotive policy advisor to the Federal Reserve Bank of Chicago and a long time, I don't want to say it that way, a person who has depth of knowledge in the auto industry, unlike many people we know. And, long career at Center for Automotive Research. Kristin is just a wealth of information. So we got her, and
you can just call me old. It's fine.
I didn't want to. I caught myself on that. I'm so very sorry. And we've got Jeff Schuster, who is the president of America Operations and Global Vehicle Forecasting for LMC Automotive, a global data company. Did I get that right, Jeff?
Perfect. You got it, Gary.
Yeah.
Okay. So just wanted to make sure that we got it all in there.
Yep. We've made the parent company happy now.
Check that
Great.
box.
Absolutely.
So what should we talk about today?
Well, okay. So here's what I want to do. I want you guys to level set this for us. Okay. So Kristin, Jeff, let's start by each of you talking about, how you characterize the period we're in right now in the auto industry. I mean, what are the things that people really need to be paying attention to?
Well, I'll say nothing is normal still. It's getting back to normal, but nothing is normal. And, we started the year with, I think Jeff might agree, cautious optimism that this year some things would start to work out and get a little better. Production recovery is underway. There's companies that are managing their inventory a little bit more closely. Prices are starting to mediate and level out to address some of the affordability, and there's still a whole lot of pent-up demand out in the retail customer as well as fleet. One of the fleets that we don't think about too much is government fleets, and many states and the federal government in particular are looking to buy EVs or plug-in hybrids, and they haven't been able to get them, and they haven't been able to get them at the prices that governments usually pay. So there's, I talked to a state that was getting ready. The legislature was going to pull their budget because they put in their orders in October when their fiscal year started, and getting around to the end of the year, they still didn't have the vehicles. So there's a lot of demand out there. We just have to see how strong it holds up this year.
Okay, I got to jump in here just to ask, because it just hit me as you were talking about that. If the government buys EVs, does the government get a rebate from the government to buy them?
Well, I don't know. State governments might. And I think that that's some of the stuff we're looking for when, Treasury puts out some of the more, teeny tiny details that they're expected to put out on how exactly these programs are supposed to work. We're expecting that soon. I'm going to do a webinar on that on April 6th with some of the top people who have been in the mix on the IRA next steps of revealing how this is going to work.
Well, if the federal government buys electric cars and gets a rebate and gets all that money back, then nobody should be worried about all the subsidies because the money's back in the bank, so to speak.
I don't think the federal government's going to get the subsidy, but I could be wrong. We'll wait to see how Treasury works that out, but it seems unlikely.
So sorry, Jeff, I just
Yeah,
had to
all good.
interject, but yeah, to Gary's question, how do you see things going
Yeah,
on?
I definitely would agree. I might change cautious optimism to cautious chaos. It seems like, and this is just a continuation, obviously, from the pandemic to where we are now. Things are certainly not normal, but I think what normal is up for debate as well. The industry is improving. So I think that's where the optimism was there at the beginning of the year, and I think it still should be there to be fair. But I think there's a lot of questions on what happens through the remainder of this year. I think disruption is less than it was. There is still demand out there. Pricing is leveling off, but is still a problem. So the market the new car market has shrunk. New vehicle market has shrunk, and I think we may not go back to the size that it used to be. So I think that's, as we look at transitioning here, and there's a whole lot of transitioning going on in the industry. I think that's one of the questions is where does it finally fall to something that is normal or at least repeatable?
Well, and there's implications from that too. Like if we've underproduced vehicles for the last 3 years.
Yeah.
So we've underproduced future used vehicles. And so the used market is going to be tighter, prices will be higher, and affordability will remain challenged there because there just aren't those vehicles coming off lease. We haven't had many leases, and people are holding on to their cars because they know it's hard to get a new one. So I think that, things are just not flowing the same way as they were when we were making, 16, 17 million vehicles a year.
So Jeff, if the entire market is smaller, is this a case, as perhaps Kristin was suggesting, that people are holding onto their cars and that's going to become the new normal, as it were, that you just have a car that's 10 years old and you think that's normal?
I think that could be an element of what becomes normal. I think there's definitely a change in the consumer's behavior because they went and looked for a vehicle and it wasn't there, or the price wasn't affordable, or some combination of the two of those things. So I think, we've all gotten used to waiting for things and maybe putting off some of those decisions. And I think that is going to be part of what becomes normal as we look forward.
So why do you think the market has shrunk, and where do you think it's going to settle in? Because what you just said there, Jeff, that has massive implications for this industry, overcapacity and a whole bunch of other things.
And that is something we're watching. Overcapacity is a concern, and we can get into that as we talk about. I'm sure we're going to get into EVs, so we'll talk about that in the EV element. But I think when we look at where does the market settle, and why, I think it comes down to price. So price has inflated so much. Incentives are not being used to the extent that they were to help offset that. Where interest rates have increased, obviously that's not a permanent situation, but I think there's an element of that plays into this. It comes down to affordability, and I think if the industry, and I'm talking about the OEMs, if the OEMs continue on the path of we don't need to build as many as we did previously and sell them at a discount, that will play into this and keep prices inflated to a degree. Now, I think they're going to come down, but maybe not to the level that allows the industry to get back to the size that it was previously. And that has all kinds of implications, as you mentioned, John. I think if you look at eventually, if you have less new cars or less turnover, your used car market doesn't get the feed that it did before. So this kind of plays off of itself, and certainly has major issues with consumers that are on the fence of being able to afford a new vehicle.
Well, it's interesting that earlier this week, Jack Hollis, who runs Toyota in the United States, says that he sees us going to above $50,000 as an average price for a vehicle. I mean, so he sees things going north, and and here's a guy who's operating a company that basically has vehicles at all price points, from a Corolla all the way up to a Lexus, and the other OEMs, basically mainly those couple in town, have gotten away from their sedans and so on and focusing on trucks and SUVs, which are more expensive vehicles. So, I mean, where does the affordability come from? I mean, Kristin, do you see any opportunity for there to be changes there?
Affordability comes when when you're manufacturing at scale. And I think this is a big problem as we go through this EV transition, that we'll be losing scale on the ICE side of things, and we'll be gaining scale, but not quite there. So these lines are kind of crossing as the EV ramps up and the ICE ramps down. That we're not going to be producing vehicles very efficiently, and that leads to cost inefficiencies as well. So
oh, we lost Kristin there a sec. Well, Jeff, let me come back to you until she comes in.
I think I'm back.
Yeah.
Yes,
okay. Good. Yeah.
Well, you were back.
Or you were
maybe
back.
not.
Yeah. So Jeff, a good market was, pre-COVID, 17 million a year. What do you see it settling in at?
I don't think it's going to be a massive reduction, but I think we're looking probably in the 16 range is somewhere, where we think is likely a healthy industry and an industry that's sustainable. And I think, what Kristin, where you were going, I'll let you jump back in, but I think absolutely there is a balance here between pricing and incentive structures and plans and the manufacturing side. And right now it's completely out of balance. And I think that does need to sort out. And if you lose efficiencies because you're at lower volume and you aren't or can't produce at those levels, something has to give.
Well, and those volume constraints impact the supply chain as well. So if you're a supplier that's used to supplying on, say, the biggest program there is, the F-150, on the ICE side of things, you're going to be losing volume as they shift over to selling more Lightnings. And losing that volume, you may need to have different way of approaching that, and maybe those contracts don't look as appealing for the supply base after some time. They're all trying to make this transition to EVs as well. So like, how do they stay in ICE with lower volumes? It's going to be tough, and have to invest, because we'll likely see new regulations for fuel economy and greenhouse gases. I mean, they're expected to come out for the 2026 and beyond. And, I don't know that anybody thinks they're going to be weaker. So like, how are they going to stay up on the technology and push that forward at lower volumes?
Well,
to the point of ICE engine.
Sorry, go ahead, Gary.
Go ahead, Jen.
No, after you, Gaston. So both Jeff and Kristin, we'll start with Jeff though. Where do we stand in terms of capacity in the North American market right now? Because if you're right, Jeff, and a good year is 1 million units lower than what a good year used to be. I mean, the fallout is going to be drastic.
Well, and I'll cut to the chase as well. I think as we're going through this EV transition and that capacity comes online, there's not enough being taken out of the industry in terms of ICE capacity to offset it. So you end up increasing capacity, and then if the sales side of the market doesn't pick that up, which we don't anticipate it fully picking up, then you've got utilization problems. And I think that's what we're looking at. Globally, we used to look at the industry as healthy at, say, a 70-75%. It's 80 in mature markets typically.
Capacity
utilization. Yeah. And we've been in the 50, pushing to 60% range now. And right now our forecast is suggesting, as it stands, we're at about a 65% utilization globally, 5 to 7 to 10 years out. So that's not sustainable. So I think that's where we're going to have to either see some movement on the demand side to get more, sales churn, if you want to look at it that way. So it could be leasing and to get people out of their vehicles sooner than they are right now, or it's going to mean some capacity and probably that's going to be focused on ICE capacity is going to have to come out sooner, because that's really been a hedge. As we go through this transition, the manufacturers, they don't want to completely let go of the ICE just in case, and as consumers are moving in towards the electrification direction, in case it doesn't go at the pace that they expect. So you've got a bit of a hedge here, and I think that hedge is going to cause inefficiencies in the industry and certainly pressure on profits.
So, Kristin, same thing to you. I mean, I've asked automakers about this, the legacies. How are they going to handle this transition, from ICE to BEV? And they know that they're going to have to take out capacity. They don't want to talk about it. They will, certainly not to me, they will not talk about it at all. How are they going to handle this?
Well, why would they talk about it? I mean, I'm not going to talk about it. Jeff is really, he's the forecaster. He's looking out there. We are adding capacity to build EVs. There's new plants, there's new operations coming online, and the fallout is not not known, but letting it be known in advance is not advantageous to anybody in the industry. So Jeff's the expert. I'm going to let him talk about it.
All right, Jeff. So let me put this to you. So Consumer Reports came out with a study today. Excess demand, the looming EV shortage, and one of the points they made is, and I will quote here: cumulative ICE vehicle sales between 2020 and 2022 fell by 9.4 million compared to the 2019 rate, while cumulative sales of BEVs, PHEVs, and hybrids increased by only 1.8 million. So, I mean, you talk about a disparity there, 4.9, 1.8. I mean, it's crazy.
Yeah. Obviously, there was a pandemic in there that might have caused some of the sales of the ICE vehicles to drop as well. So I think, compared to 2019, obviously there's other things that happened, but no question about it is, again, as we go through this shift, the capacity is coming online and it's moving quickly. To be fair, it's probably moving a little faster than I would have expected if we were to go back 5 years. We certainly didn't forecast what we're forecasting now in BEVs or even other electrified versions of vehicles. So it's the industry's all in on it. It's just a matter of when and what that trajectory looks like. And then are consumers going to come along for the ride, or are they going to have to come along for the ride? I think that's where we're at.
Well, in this smaller market, I think you can agree that consumer has changed a bit. I mean, this is a much more affluent consumer, was relatively buffered through the pandemic. And so, these are more expensive vehicles, and to the fact that they are, that what's being produced is more expensive and what they're buying is more expensive, leads to, this is just a really different mix of consumers than we had before 2020.
So Kristin, and this is, the headline for the show, are we pricing the average American out of the new car market?
Yeah, that's a hard thing to talk about, but
yeah. Well, let me put it this way. Remember, there used to be a guy in Detroit here, David Littman. I think he worked at Comerica Bank, and every year he would put out a study that said how many weeks of income the average household had to spend to buy a new car. And it was typically around 24 weeks, so just under half a year's pay. And I think right now the average household income is about $65,000.
Yes.
Is that right?
Yes.
So, half of that, that if it were to hold to the historical standard, the average car today should cost about $32,000, $33,000. And instead it's knocking on the door of 50 grand. In fact, you guys know it's going to go over 50 grand in the next month or two. And so, I mean, that leaves the average household either going into much longer payments or much more debt, or just saying, forget it, I can't even afford a new car. I have to buy used.
Well, Cox and Moody's do that index now, and I think it's been around 42 weeks.
Wow.
So that has gone up quite a bit.
That's unprecedented. That is I wasn't aware of that number.
Yeah. And they update it every month, along with the average payment, which was, in the $700-800 range average payments. That's a huge number for most, $65,000 average households to take on. And you're right, transportation in this country, at least, this is how we get to work. There's very few cities where you can go without having a car. Um, the Argonne National Labs did this great study about where the oldest vehicles that travel the most miles are. So these are the most polluting vehicles. They're owned by people of lower income status, and they're in inner cities and rural areas. And those are the people who drive the most in the oldest cars.
Hmm.
And that's, if we're looking at, um, there are public policy goals out there to have a cleaner environment, less polluting vehicles. The EV transition is supposed to address this. Then, affordability has to be part of this. And, I come back to it's scale. Like until we can get this at scale, and get some of the battery chemistries sorted out and get that at a much lower cost, we're going to be a ways away from that.
See, but Jeff, do the OEMs have an incentive for scale when they're able to make profits by making fewer vehicles, just higher margin vehicles? I mean, to the point of what I was just looking and KBB's latest number is $48,763 is the average transaction price for a vehicle. Okay, this must make people really happy because they don't have to. People at car companies very happy because they're making a lot of dough. So why should they shift?
Well, I think, I mean, that does have implications. I think if we look, and this really has to do with that capacity issue that we talked about earlier, is not letting go of that ICE capacity, because the investment, the push into adding or converting factories over to EV capability, that's all taking place. So yeah, while that's happening, these profits that are going on today are paying the bills, and I think that's part of the problem as we look through this. Is when can you make that full flip where the EV technology and vehicles start essentially paying and contributing to profit, and that's certainly a ways away yet. So it is a big concern. I think it's a big issue with each of the OEMs as they look at their individual plans on this transition and on the commitments, because the commitments are there. It comes down to that time frame and time period.
Well, and you can remember the late Sergio Marchionne when he spoke about one of the EVs he had in his lineup, and he was at Brookings and he said, "Please don't buy this car. I lose $14,000 on every one of them.
Right.
Please do not buy my car." It was quite a switch from Lee Iacocca, from the quintessential salesman to "Don't buy my car."
But that's a head in the sand attitude. I mean, come on, you look at Tesla right now, it has the highest per unit profit by far, double Mercedes-Benz, which heretofore had been the highest profit per unit car company in the world, not counting the exotics like the Ferraris and the Rolls-Royces and the like. But yeah, for a CEO to say, "Please don't buy my product," is about as crazy as it gets.
Well, that was a long time ago too. and he was in a different position. But I mean, what Tesla has is scale, right?
Right.
And starting from the ground up and not having to manage this shift. They don't
have the legacy, right? Absolutely.
Yeah.
It's a huge advantage. Yeah.
So Jeff, you were suggesting that the OEMs are basically hedging their bets somewhat by maintaining ICE capacity. And you look at what's going on in Europe now, where basically they're saying, okay, in 2035 you can still have an internal combustion engine as long as this is running on e-fuel.
Right.
Isn't there the possibility that in this country the same sort of thing would happen? Because I mean, it seems to me that in part the auto companies are going all in on EVs because they see this as being a new bright shiny object that people want to buy, and there is the regulatory consideration. But if regulations can change, and we're seeing that in Europe, because I mean, it seemed like a done deal if you had an internal combustion engine after 2030,
Yeah,
you know, so,
it was done, right?
Yeah. I mean, in the UK, it's still saying 2030. It's, you can't buy a new diesel or gasoline powered vehicle. So,
Yes. So yeah, I think that could potentially happen, and I think again that probably is contributing to the position we're in right now of not wanting to make a full, like, we can't back away from this now, shift, because it's still very fluid. There's still a lot of decisions that are needed to be ironed out. Things can change. How we get to the end point, when that end point is, certainly there's a lot of paths there. So I think that's probably part of the issue and part of the problem. And if you're running an OEM and you're trying to maximize profitability, obviously shareholder wealth, all of those things that drive decisions in the near term, and you've got a fluid longer term picture that you need to move into this direction, the path to that can take a lot of different scenario shapes. And I think they're clearly running different scenarios, but that is really challenging. And I think that's just the environment we're in right now as an industry.
So
Well,
Jeff,
and
you're
if I could jump in for a second, if you look at the recent history, the regulatory pendulum has swung back and forth in the US, in Europe, it's doing it now. But this is a global industry. And so even when the regulatory pendulum swung back in the US, the EV investment carried on, and the move toward electric vehicles carried on, because that it's going to swing back again and maybe swing back even further. Plus, you have to meet the regulatory requirements of all the other markets where you sell. And those were going forward at the time the US moderated the regulatory standards. So it's a very complicated, multi-level optimization problem that they're facing with regulatory winds blowing back and forth. But if you look at the path is more and more stringent over time. So even if it becomes less stringent or the growth rate slows, it's going to come back, or it has in the past. So that's what they're going into.
So Jeff, you're the forecaster. Everybody knows ICE plants are going to have to close at some point. In your forecasting, when do you think they're going to have to start biting the bullet and closing plants?
Well, I think if we look at that utilization that I mentioned, that 65% in the outer years of our forecasts, and that's a global.
And as you said, that's not sustainable.
Yeah, it's not sustainable.
65%, you can't run the business.
Absolutely not. Not at a global scale level. So here's the forecaster me, somewhere between now and the end of our forecast horizon, which say is 2030. No, in all seriousness, I think that has to be a phased in, period. So I think we will, over the course of the next 3 to 5 years, certainly see a fair number of ICE plants that probably will get shuttered. That has implications clearly across the industry, has union implications, not only here, but in other parts of the world. And
Europe especially.
Europe especially, yes, exactly. So I think, what should be done, or I should say what needs to be done to get through this transition, and ultimately how it's done, probably are two different things. So it likely will take longer than it needs to run efficiently.
Well, and we've been through periods where we've had a lot of plant closures before, and not everything that's excess capacity gets closed. There is reinvestment that happens. You can look back to the raft of plants that were put on ice during the last the Great Recession, and several of those are producing vehicles now still, and a handful of them closed. So I think to think that just all excess capacity, there's going to be some negotiations. What has happened in the past is which states will give you good incentives, and who really wants to keep those plants. That's how that all played out in the last big round of closures.
Jeff, do you see an anticipation whereby there's like a 1-to-1 replacement for vehicles that, okay, the ICE vehicle's out, but the EV comes in? Or is the industry going to change to a situation where the number of vehicles as a total is reduced on a global basis?
I suspect we will see strategies that look like that in both directions of that. So I think in some cases there will be certain segments, certain vehicles, a 1-to-1 replacement. In others, I think it's going to be a different makeup. My gut says the number of vehicles, at least in this transition period, maybe not 20 years from now, but at least, and that's a whole nother, there's a lot of different issues around 20 years from now, but I think in the midterm forecast range, I would suggest the numbers probably go down if we get the ICE vehicles completely removed from the markets. Because I think during that transition, you maybe on a global scale, again, looking at the major markets, because obviously emerging markets aren't going to be there yet. But I think in the major markets, you're probably looking at a transition that's not quite a 1-to-1.
So
hey, look, we should take a quick commercial break right now. 15-second break. We'll come back, and Gary, hold that thought, and we'll pick it up again.
How do Bridgestone tires stop shorter on wet roads? It's their HydroTrack technology. But you don't have to know how the science works, just where the brake is. What really matters is their Bridgestone.
And thank you, Bridgestone, for making this show possible. But sorry, Gary, I interrupted you there.
Well, so I was going to go to the point that, so Jeff, if we're going to have fewer vehicles being manufactured because, through this transition, so in total, there will be fewer, it would seem to me that would mean that there's a likelihood that EVs would continue to be more expensive than ICE vehicles, which then gets to the point of the affordability thing. And because fewer people are going to buy these vehicles, then this gets to the point of the volumes produced would be less because there wouldn't be demand for them. And so it's a big mess. Is it like a bowl of spaghetti? I mean, it's just...
It could be a bowl of spaghetti and add a chicken and egg in there as well, because I think you can get to scale, and which will lower the price points. And there's likely going to be some level of battery or other technology breakthroughs or improvements. Maybe not the breakthrough that is going to solve the pricing issue completely, but prices will come down. So yeah, I think on average, I wouldn't expect an EV to not be more affordable than an ICE vehicle through the forecast horizon. This idea of parity, maybe not the case, but there will certainly be improvements in that. And that will contribute to more affordable products. I think we will see, there is some white space in the industry, no question about it. And that is in an affordable entry level new vehicle. Will someone be able to jump in there and make a vehicle, an EV that's profitable? There's a lot of talk. I know Elon has talked about that as well. So I suspect we will see more affordable EVs as we move through this. And I think we'll also see the numbers increase as we get towards, if we get out of the 5-year horizon and we get more through this transition that I'm talking about, I think we will see the numbers start to edge up. You're gonna see additional competitors come in. That competitive pressures is going to remain very strong. So that tends to drive a lot of people moving in the same directions if someone gets there first. So again, I think over time, we'll see those numbers come back up on the model counts.
Well, the automakers are counting, and this is them telling me, not me making it up, that they expect EVs to be below the manufacturing costs of ICE before this decade is out. But then the question becomes, and maybe Kristin, we start with you, will the public go? Will the public, there's various studies that show there's a significant part of the new car buying public that wants nothing to do with EVs. But, maybe if they're cheaper I would argue they're a better driving experience. Can you change those people's minds?
Well, I think we're going to see if they can change a lot of people's minds. I mean, you can look to Norway, where they kind of creeped up, and then the move from 20% of the market to 80% moved very, very quickly.
But Norway's a funny situation because there's
Yeah.
100% tax on ICE vehicles, so you can
Right.
literally buy an ICE for half the price.
But still people were, so it was, but I think the block for many buyers is the infrastructure, and and range anxiety and charging. You can look to the Infrastructure Act, the IIJA that passed last year, that's putting I think $7.5 billion into building out a charging network through the NEVI, the program that's a grant program to states, to put every 50 miles on the major trunk lines at least 4 level 3 chargers. I think when that becomes faster, more available, more reliable, then that could be that point where things start to take off.
But to follow what John is saying, about the consumer demand for EVs. I mean, it seems to me that as we're still in what would be arguably the early adopter phase of this, and the numbers comparatively are low. There are a lot of people who do not understand, the nature of owning and driving an EV. They may be more fun to drive, but unless you have charging at home, waiting in lines at charging stations, even if there are more chargers, and there have been some estimates that even with all of these new chargers being built, we're still going to be woefully behind what would be needed. That people are going to say, well, wait, I've got to wait 20 minutes behind this guy rather than 5 minutes as I do at Costco right now when I'm filling up my tank. The whole convenience factor is going to, I think, hit very hard. And so, Jeff, do you see that this might be a possibility of there could be, a growth like this and then a plateauing of interest and demand for EVs when this whole new way of life hits people?
Yeah, I mean, I think that's an interesting thought. Clearly, the infrastructure is one of the big roadblocks, I think, in most consumers' minds. Obviously, price is still a factor. The anxiety, I think, is still there, even if it's not real. It may be just perceived, but I think infrastructure is real, and it's twofold. It's the weight, and it's also just trying to, where are they? Where are the chargers? Are they convenient for me on my road trip or even around town? And then, to your point, then you get there and you have to wait for it. And while I think we got used to waiting for things during the pandemic, I don't think this is one of those that anyone is willing to wait for, especially if it adds. So you've just driven out of your way to find a charger on your road trip. Now you've got to wait while you're there. So you're just adding time to get to your destination. And I think that's a significant problem. So I suppose there's that possibility that you get a wave of buyers that come in, and maybe that's because of an incentive or just a general interest, early adopters, as they're moving into the vehicles. And then there's a pause because they're having those type of issues. I suppose that's a possibility if you get enough of them come in that you essentially take the charging infrastructure before it can get to where it needs to be. So I think that's a risk. I think ultimately, and there's probably a gap when the charging infrastructure gets there before the consumer knows that or realizes it or is willing to give it a shot. So I think all of that comes into play on the level of the transition that we go through.
I've talked about there being 3 parities for a long time. There's the cost parity that we focused on earlier. There's this infrastructure parity that's being addressed through some public money, as well as, the private networks that are building out. And the third one, the auto industry is working very hard on, and that's, the having the right vehicle. So the first EVs were small little cars that not every family fit in, and now we have EVs across the range of product. Pickup trucks and SUVs and anything that you might want to buy, there is an EV available. So that's the utility that is in a vehicle that people pick. That's being addressed. So it's price parity, utility parity, and convenience parity. And convenience, I think, is a real challenge.
Well, a lot of it is just got to do with making people aware of chargers being out there, because I hear people tell me all the time, there aren't any chargers out there. I don't see them. And, they see gas stations with big signs and everything like that. And if you're driving down the highway by the exit, there's a sign that shows you which gas stations are at that exit. There's nothing that shows you where you can plug in. I mean, if I were the industry, I'd start.
Yeah, you have an app. Yeah, that's right. It, right?
But you have to search the app and know about it. And only people who own EVs are going to do that. If the general public started seeing, I don't know, an icon of a plug and it said EV, all of a sudden they'd start to realize, oh my gosh, there's a whole bunch more charging stations than I ever realized. I think that would help to break down the perception that there's no place to charge in.
Well, I think part of the bipartisan infrastructure law, the $7.5 billion that is going into charging, part of that is about signage. Part of that is about, I mean, there's a whole laundry list of things that, are sort of unexpected, in terms of, they want to be able to have transparency in pricing. There has to be the same ability to pay across the board. But yes, signs. Yeah.
Signs, it takes all payments, it charges all vehicles. They have to have communication so that they can be monitored for their reliability. There's reliability standards that they have to meet, which is, quite frankly, with the early adopters, they're running into some reliability problems. You find the charging station and you get there and it doesn't take your payment, it doesn't fit your car, it's not working. So, it's pretty wonky right now. But, this is aiming to smooth it out, at least along the major interstates, and every 50 miles. And, states don't have to participate in this. It's voluntary. But it's a grant to them to take that on. And, if there's extra money after they have fulfilled the requirements of the program, then they can look at other roads as well.
So I'd like to get your guys' input too on where you see the U.S. economy going. Because towards the end of last year, a number of automakers were forecasting, and other forecasters too. I don't know where your forecast was, Jeff, but there was talk of a 15 million unit SAAR in the U.S. for 2023. And now everyone seems to be backing off that. The most recent one I saw was 14.1 million, 900,000 units lower than that. And it seems that late last year, everyone was expecting 2023 to be a whole lot better the year than maybe it's turning out to be. How do you see the year's going to go? Because again, that's got big implications for sales of electric cars and for the health of the industry overall.
It does. No question about it. Well, interestingly enough, our forecast has gone up.
Really?
In the most recent edition. So
what's it at? What's your number?
So we're at 15. So we haven't gone up a lot, but we went up about 100,000.
I'm going to believe your number. I like that number a whole lot better than 14 million.
Right? It sounds a lot better, doesn't it? But I think, is there a risk that? Of course there is. But our view is, so there are a few things driving that. We think the disruption is holding at a lower level, and that hasn't increased. So there was a question of, last 2 years, we had this thought in the beginning of those years that, it's going to improve as the year goes on, not get worse. And obviously that wasn't the case. And I think right now it does feel like the industry is performing much better. Inventories are building. I would argue while there's still demand pent up, when you pull in the affordability issue, there is some issues that we see on the demand side, and it's just, again, it's that shrinking level of the market than it is. Not that people wouldn't want to buy a vehicle if they could afford one, But I think that is having implications here, and that could cause some concerns in the second half of the year. I think when, I'll leave the economy to Kristin as well, but I think our view in working with some of the folks that we do on the economic forecast is that actually, now it may be pushing things out, risk out, but it actually is improving. The outlook for the year is improving as well. So yes, there's still a lot of risk, and I think there's still a good, a good probability that we end up in a recession at some level or at some point. But when that is and what that looks like, I think is still a big question mark. The consumer has been extremely resilient in the auto space, and I think the other thing that we're putting a lot of merit in when we look at the volume forecast is this rebuilding of the fleet markets, not just rentals, but rentals need vehicles really bad. But so does the government and commercial fleets that weren't able to get their orders over the last few years. So that alone, I think, is going to create a level of stability in the overall market. Now, the retail market to consumers maybe isn't going to be as robust as it might have been expected as a recovery pace, but I think the combination of those two areas get us to that level. At least that's how we see it right now.
Mm-hmm. Kristin, what do you think? You see things doing pretty well, a pretty healthy year?
Well, this reminds me of something that I often forget because I've only been at the Fed about a year, that I have to have a disclaimer that when I speak about the economy, I'm speaking for myself, not anybody, not the Chicago Fed, not the Federal Reserve. I don't speak for Jerome Powell. But what I would like to go back to is what we started with, is that things are not normal. In a normal year, when I used to be a subscriber to Jeff's forecast, we would get quarterly updates of the forecast. How many times did you update last year, Jeff?
Oh, a lot more than quarterly, yeah.
Were you updating in November, when we usually get pretty good at forecasting the end of the year by the end of the year?
Actually, the end of the year wasn't too bad, but to be fair, it's really more of a real-time forecast now than it is deliverables on a quarterly basis.
But things are changing so rapidly, and we started 2022 not knowing that there would be a war in Europe. We didn't know that China was going to lock down on COVID like they did. We used to call these, the black swan events, but they're kind of knocking the recovery off kilter every so often. So all I'm going to say about the economy is that, the Federal Reserve, the chairman is, they're committed to getting inflation down. Inflation has been just way too high. And that, is the goal of the Fed. And, at their last meeting, they said that there would not be rate cuts this year. But, overall, there's still growth in the summary of economic projections, the modest growth in the economy. And so that's where I'm going to leave it. Like modest growth in the economy, no rate cuts. That's what they're talking about.
So Jeff, I want to ask you, so, you're talking about the end of your forecast horizon, so 2030. Okay. So as we're moving to 2030, there will still be a massive number of vehicles sold that have internal combustion engines. So, I mean, how do you see the OEMs working through the change that, as we were talking about earlier, on the one hand, you want people to buy your brand new EVs because you just sunk a ton of money into new plants to build them. But at the same time, you do like to pay your bills. Well, maybe you don't like to pay your bills, but you have to pay your bills. You have to, and therefore you need to get those ICE sales as well. I mean, how do you see this being executed?
Very carefully. I think you talk about change of a forecast, change of a plan because of consumer behavior, because of external factors, shocks that are going to happen between now and 2030. That I can forecast. I can't tell you when or what they are, But I can tell you there will be disruptions. There will be things that are positive and negatively get in the way of what's expected between now and then. And I think honestly, the vehicle manufacturers are going to have to monitor that, and they're going to have to be ready to make fluid and flexible decisions. And I think, again, that's part of the reason why there's some redundancy that we would expect over this midterm horizon to allow for changes in the path. And I think that probably, I think more than probably suggests that the industry is just not going to be efficient over this period until we get to closer to that endpoint where you're at 75-80% EVs and not 50-50. So by 2030, we expect to be in that 50-50 period. So I think that progression that happens, you're going to see the EVs continue to come on, and the reduction of ICE, probably the lower and slower selling models as their counterparts that are electrified outtake them. I think that's where you'll start to see that happen. I suspect those high margin segments, as long as consumers are going to buy them, those are going to probably be the last to go, would be my expectation. But again, the regulatory environment could change that as well. There's a lot of different angles here. So I think fluid and flexibility is probably the name of the game.
Well, and can I jump in and say, one of the things is this industry does learn from things that have happened. So, there was this big tsunami in 2011. There was a Great Recession. There's, fires, tornadoes, all sorts of things. I think we have a much more resilient supply chain now, much more resilient and flexible. And there's just greater knowledge from, the automaker, the tier ones, into their lower tiers of what's going on and where their risk points are. I mean, every one of these things just revealed, pull back the onion a little bit further and where are their issues and address them. And, through this whole period of the pandemic, supply chain managers have been working overtime. I mean, if you were to give an award for, keeping the industry going through the pandemic, it's the supply chain folks who have had to deal with, potential rail strikes and all sorts of other things that could throw production off kilter and still, continued to produce other than those 2 months that we were down in early 2020. So the resilience is built in every time there's an event and there's learning, and they just figure out how to do this. And I don't know, it's quite frankly amazing to me how quickly things can get back online. Because this is,
and I think,
all the financing is screwed up. Like when you don't, the payments come differently, and all kinds of other implications for the suppliers, like, where their startup capital comes when you shut down. But that's all been working pretty well, even if there are these major disruptions that keep hitting us.
Yeah, and I think, just to add on that really quickly, I think that notion of learning, that will happen during the EV transition as well, not just dealing with disruptions that will happen, but I think as we go and progress further here, as we see a 10% market share, a 20% market share, those events, getting to those stages, those gates, there's learning that's going to come with that. And I think how to increase, from a manufacturing standpoint, how to do that efficiently, yet still produce both types of vehicles. I think there's going to be additional learning there. It will likely lead to those that do it well and those that maybe struggle or have a more difficult learning path. But I think nonetheless, the industry will get better as it goes through this transition.
Well, and can I just, one of the things here is, some of the EVs that are in the market are EVs that were sort of bolted onto an ICE platform or an ICE architecture. When we get to those vehicles that are on purpose-built architecture and the efficiencies that come with that, then that could really be a game changer as well. So there's redundant parts in EVs. Some of the EVs have, because they were an ICE vehicle, they have some carryover parts that they don't actually need if they're only an EV. So you can get to a lot more efficient production when you're on a purpose-built platform. And again, that's an advantage that the newcomers who are making only EVs have.
Mm-hmm. Jeff, I want to go back to your statement. You think that the U.S. market will be at 50% EV or around 2030. That's more bullish than I am for it. And it's got huge implications for a number of automakers who do not believe it's going to be anywhere near that. Why are you confident it's going to be 50%?
Yeah, I mean, maybe I was rounding up a little bit.
Okay.
I think we do take our EV forecast out a little bit further. I think by 2035, and that's a big curve there. I think we're at 55 to almost 60%. So yeah, I would say 45 though. I think we would expect to be close. So I think, yeah, there's for us, it's this. The two-way push. It's the regulatory environment, and again, that could change, but I think our view is it will likely be continue to move in that direction. And then I think it's the industry has said we're doing this. If you look at the investment plans, and I think at some point, if you don't get to those levels, this really doesn't work, and we're going to have a much larger problem. So it comes down to the consumer, comes down to those issues that we talked about that are driving or holding the consumer back, the price point and infrastructure being the biggest one. So I think as long as those come along for the ride here, we would anticipate getting to those levels of north of 45 to 50% by that time horizon.
Can you say what you see, Kristin? Oh, maybe we lost her.
I think we lost her again.
All right. So Jeff, you were mentioning that if it doesn't make it to there are going to be some big consequences. What would those consequences be like? I mean, more plant shutdowns or?
Yeah. I think you just have, if we can't get through this transition, we're going to see increased EV capacity, increased model availability of EVs. Essentially, that would suggest those are not then selling at the level that they need to, which you've got this massive investment that then doesn't pay for itself, and you don't have enough ICE to offset it, and it just creates a highly inefficient market, and one that is certainly challenged on the profitability standpoint. I think then you have implications, management structure. Manufacturing, unhappy shareholders, clearly. So I think all of that just plays into an industry that we don't want to see.
Yeah,
Kristin,
the valley of transition would just be. I said the valley of transition would, the longer it goes on, the more difficult this is.
Yeah.
So, if the transition, where we are not producing anything at full optimal scale is short, then you can get to the other side and things are better. But if this gets drawn out for whatever reason, and Jeff's got a lot of that covered, then it just becomes much more difficult.
Yeah.
Well, good. Well, look, we're just about at the top of the hour here. Probably a good time to wrap it up, but you sure have given us a lot to think about here. My gosh, this is going to be, look, we've said it all along. It's going to be fascinating to watch, but you guys put a couple of red flags up there that I think are going to make it even more interesting than I thought it might be. So thanks for coming on. Kristin Dziczek, great to have you here. Jeff Schuster, you too.
I really enjoyed it.
Thank you.
Yeah, thank you.
And Gary, we'll keep on doing this.
Okay, see you next week.
Autoline After Hours is brought to you by Bridgestone Tires, solutions for your journey.
If you like this program and would like to learn more about the automotive industry, check out our website at autoline.tv or look for us on YouTube on the Autoline channel.